So first of all, let me just give you a quick, very quick answer to that question, and then I'll go to the next part of the, point where I want to cover more of. Is there a funding winter? My quick answer is no. What is really happening today is probably more rational investments. There used to be irrational investments. It's more of rational investments. So to that extent, I don't see that there is a funding in winter, at least in the very early stage of the ecosystem. I'll talk to you more of that in terms of what I thought was when Mohan and Prabhakar spoke to me. I thought I'll just give a quick perspective at a very high level on what we see as a venture player in the market, and also just cover a bit of what we look for in typical startups and what you should look for when you're raising funds. And that was a good show of hands, just understanding how many are actually kind of looking at raising capital, and this may be pretty helpful for some of you folks. Quick background, we've been in the market since 2007. We've invested in over 60 companies. These are just some of the names there across various sectors. And every year we keep investing around 10, 15 investments. So yes, we are investing as well. Just a quick perspective in terms of numbers. If you see is there a pointer? Okay, it doesn't work. That's fine. So if you see the bar chart part of it, that's actually the amounts. I don't know if the last rows can see this slide. The bar charts indicate the amount that has been invested in every quarter in the last 6 quarters. And the line chart there indicates the number of investments that have happened. This is only in the VC space. This is not to take into account the large private equity investments. And I would call private equity anything which is more than Series C, Series D onwards. So not counting those investments. This is how the numbers have been trending in the last 6 quarters. This is from Venture Intelligence, which kind of accumulates all this data. What you see is interesting. In 2015, which I think everybody in India would have seen because of so much of coverage in economic times, there was investment happening left, right, and center in seed and early stage. And you can see that in the first 2 bars, where you had around 500 million and 600 million, which was getting invested every quarter. Whereas if you see in the last 3-4 quarters, it's kind of stable in the range of around 300 to 350 million. The most recent quarter ending September, the numbers will not be fully counted for. Some people would not have reported yet. But what you see is there is $350 million that has gone into seed and early stage ventures. Some of them may not be reported yet. And the numbers, I think the number would be somewhere around 90 again, including all the ones which will get reported in the next month or so. So what's the quick takeaway here? If you actually look at what happened in 2013, 2014, and 2015, and now in 2016, 2013 and 2014, we were seeing roughly around 800 million or so every year, which was getting invested in the seed and early stage. 2014 was close to $1 billion. 2015 was close to $2 billion. And now 2016 will end up being somewhere around 700, 800 million cumulatively. So what you see is there was a flattish investment happening every year around 800 million. You suddenly see a surge in 2015, and then it come back to normalcy. And we'll see why some of this has happened as we move along. But a quick thing that we can notice here is that the overheating that was happening in 2015 has come down. There is a lot of capital which is still chasing less number of startups. And it's really good to see that there are more and more startups that we are seeing every day. And clearly capital is available. But there is a shift and change that has happened in terms of what kind of investments people are making compared to maybe a year back in 2015. And I'll cover more of that. If you see, this is just a background for something I'll talk to you about in further slides. In general, industry stats say that around 80% of them just fail whenever startups start off. And the top 3 reasons are typically, the value proposition is not clear, which I think is a fundamental issue anyway. The second thing is more to do with the teams. The teams kind of disintegrate, break off. And the third thing is lack of capital available. And that's where I'll focus a little bit more on. I think the first two are more fundamental to the business. I think that's anyway required to raise more and more capital. But what's really happened is also that capital has to be regularly available in all stages until the companies become sustainable, until the companies are profit making. And inherently, as you know, most of the startups in India, apart from maybe a few which you can count on your fingers, are profitable in a finite period of time. Most of them are continuing to kind of build consumers, build a base of loyal customers, which is where capital is going. And at some point, there is a ceiling that one hits on, hey, this is all the capital that you have. Let's see some success, and then we'll start putting in more money. We saw this happening in 2012, 2013 as well. Just a small digression from this. We talk about e-commerce today, but all the e-commerce investments happened as the first investment between 2008 and 2012, including Flipkart, Myntra, as the first investments. Till 2012, there were roughly around 65 companies which were purely doing e-commerce, which is trading on the internet. No differentiated businesses, but each had a differentiation in terms of the verticals they were focusing, the supply chain they were building, and so on and so forth. So there were 65 companies that got funded. And in 2013, we saw a similar dip in terms of availability of capital. And you can see this in some of the reports that you may read in the news. Can anybody guess how many of those 65 companies are kind of surviving today or crossed that 2013 winter, which one may call? Any guess? Okay, great. So a range of numbers. But if you see, actually, by end of 2013, in 2014, March or so, when the market started picking up again in terms of investments, out of the 65, there were 25 companies of that which were still surviving and kind of building up. The interesting part is, in those 65 companies which I talked about till 2012, roughly around 730 million of capital had gone in till 2012 itself, in all the 65. And can you guess how much of that 730 had gone into these 25 companies? It was roughly around 580 million, right? So what it essentially means is there was a lot of clutter that was built in terms of multiple investments which had happened. And out of the 65, 25 companies had attracted 80% of that capital. And whoever had the capital and had the first two parts was able to kind of plan out and survive that part where there was a challenge and people had to tweak their unit economics, tweak their model so that they are sustainable businesses to some extent. I'm not saying completely profitable in terms of EBITDA. But once they crossed that barrier, out of these 25, again, there were around 5 to 10 companies which continued to scale rapidly, and they attracted more and more capital, right? But gist of the story is that while you may have the first and second part, capital adequacy is still an important function, but that is something where you will see some ups and downs over various years because of how the market also functions, which is where what typically investors look for also keeps kind of changing depending on what's the outlook one has in the business. And I'll just skip this and come back. That just led to how the market is. If you see the angel investor ecosystem, early stage and the late stage, and leaving apart a bit of branding in the middle, what we see today is there are quite a few angel investors and institutionalized small funds which have come up. 1 year back in 2015, what was happening was individuals investing maybe 20 lakhs, 30 lakhs, because there is probably one fund who has invested, say, $500,000. So this sector is going to be fantastic, so let me just put 30 lakhs in a similar company in the same sector. So there was rampant set of investments that was happening at that point, which has led to many companies not really succeeding. because after that 30 lakhs, there was no more capital. Whereas today, what's happened is that angel ecosystem has evolved. There are a lot more players who are kind of professionalized that investment arm, and they are looking at investments in a much differentiated manner where every business is being critically looked at and not just saying, hey, this has worked in the US, so it has to work in India. So that is no more the norm for making an investment. But you have large pools of capital which are coming up there. In the early stage, you have pretty much the same set of funds per se which are operating, which means that there is a steady stream of capital which is there, which is not growing. Ideally, there is a lot of space for that to grow as well. There is space for more investors as well. What's really happening is in the late stage, you have very few investors who can actually sustain and support these companies. So to some extent, what we see is once you invest in a seed or a series A stage in the first 1 or 2 rounds, there are not too many players who are investing in the 3rd or 4th rounds, which is where it becomes very important for the companies which are raising maybe anywhere from $1 million to 10 million to prove their business model within that capital, to prove that, hey, this is working, instead of saying, if it's a consumer play, just as an example, I'm going to operate in 20 cities right from day one and try to kind of build scale and be efficient in 20 cities from day one, versus today the market shifting to, I'm operating in 1 or 2 cities, build that efficiency, prove that business model, and then scale to other cities. So that's the kind of rationalization that's happening. Once that happens, there is late stage capital available, and which is where one perceives that there is potentially a lack of capital, which calls for the terms like funding winter, which doesn't exist at a very, very early stage, where we still see a lot of investments happening very regularly, and I guess Sunil can probably add for that as well. In terms of, if you see a slightly larger horizon of 10 years back, how was the market? How is it today? And how do we see it 5 years later? The fundamental part of capital being available, there was no seed ecosystem. There was nobody who was putting in 20 lakhs or 50 lakhs for a business to start off. Today, that ecosystem is there, and which is a very big factor for companies to start off and get off the ground. So that capital is available today. And we are seeing that getting more and more developed, more and more professionalized, so that in the next maybe 4 or 5 years, we do expect that you will have a very strong seed ecosystem, which is fundamental to get businesses started off. The second part is in terms of the early stage VCs. There is a lot more funds that we expect will start off. You have the government starting off support for some of these things, very similar to what happened in China maybe 6-7 years back. That's actually spawning more VCs to come in, more rupee capital to come in, which is people in India who are also trying to look at it, but it's still in a very nascent stage. But 5 years down the line, you do expect that there is capital available in the early stage as well. And the other interesting thing is venture debt. It's an interesting asset class where companies have reached a particular scale with maybe $4, $5, $6 million of equity capital, but they need some small debt to manage some working capital cycles, which can help them grow, which was non-existent. Today there are maybe 1 or 2 players, but that will start growing. So capital availability at a very high level, if you see, in the last 10 years to the next 5 years, it's on an upward curve. So there is capital available and will continue to be available. In terms of how investments used to happen, maybe 10 years back, it was mostly sector agnostic. People were saying anything which is a business model, which has worked in developed markets, let's try to replicate that in India. So very little in terms of core technology that was getting built from India. Whereas today, we are seeing that if some business model has started off in the US or in China, the same is being replicated in India within a 12-month cycle. So you don't have too much of a learning curve to say that, hey, this has succeeded or failed in US or China, so let's use this business model in India. So because of that, the companies which are starting in India are also innovating very quickly to the local market, and that innovation will get valued when investors look for an investment. And which is where, compared to 2015 to 2016, there is a lot of thought that goes into, hey, how will this be sustainable in the long term? One or two examples would be if there is somebody who is looking at a particular space, I just don't want to name any space as such, but if you look at one particular sector, there are 4 or 5 ways to solve the same problem, attack the same consumer. In 2015, you would get all 4 or 5 ways of attacking the same consumer getting funded, whereas in 2016, you're seeing of the 4 or 5 ways in which you can get a consumer, which is probably the most ideal way in which you will be profitable, and that's what is getting funded today. So there is some sort of rationality. And there is more and more technology getting built in India, and which we believe will kind of spawn more and more startups to be successful. As I said, the startup ecosystem is kind of developing very, very strongly. And in terms of the entrepreneur ecosystem, we are seeing that the risk appetite is only going up and not down. And the first line there is more of a trend in a large set of companies. That doesn't say anything to do with what will get funded. It's not like a criteria, but that's what we see as a trend, which is also leading to a lot of risk-taking ability among the startups. The biggest thing is the stigma of failure was pretty high 10 years back, whereas today what we call as the millennials, I was reading somewhere, this is the age and time of renters. Nobody wants to just waste money in buying some assets. People want to just make sure that they experience. They want to try out things before they become 30, 35. So, which also leads to higher risk-taking capability, and which leads to more and more, innovative things coming up in terms of business models. Because of some of these overarching themes, I want to kind of draw back to the topic of this, session in terms of funding winter, and is it there? I think in a small way, one could say that, hey, compared to last year, this year is lesser. But in the bigger scheme of things, it's more of rationality that has come in. But the overall trend is onwards and upwards. So you have capital which is available. There are large pools of capital, multiple funds which have raised capital and looking for innovative startups. But the only thing is people are looking for innovative, disruptive, differentiated startups, and no more looking at a Me Too kind of a model. And people are okay, including ourselves, we are okay in losing a deal if it seems like a Me Too model, but it's important that it shows that ability to disrupt over a period of time. So just quickly covering in terms of what are investors looking for? What are the key things that investors look for when they're looking at startups? One is obviously the team, and there are lots of factors there. I'm not going to read through it, but essentially the biggest decision that happens is on whether the team is aligned in terms of is the team building this business for the right reasons? Is the team building this so that this business can be disruptive and in the long term create value in the market? Is that the intention, or is it more of, hey, there is an opportunity, let's just build something, 2-3 years, let's just quickly flip it and move on? So that time has passed. Maybe it'll come back sometime, but that time has passed. It's really for passionate teams which are building something which can disrupt the market. And obviously a large growing market. India itself offers a lot of opportunities, but there is a global market for software products, health tech, and so on and so forth. But is there a large market opportunity that one is tapping? Or is it a small niche within which one is trying to beat the incumbent, which by itself, by nature, reduces the probability of success? So that's the second part. Is there a large market opportunity? The first point there becomes a very big point today in the current ecosystem. What's really the business model? What's really the product that one is building? And a lot of thought goes into it in terms of which is the right model, which is the right model which we as investors believe can actually scale. Now we may go wrong, but one is actually putting a lot of thought into it before an investment decision is made. And there's no hurry for an investment to happen. And more importantly, very clearly knowing that in a 12 to 24 month time cycle, there is no market for a lot more capital to just follow. With the 3 million to 5 million to 6 million investment that goes in the seed or early stage investments, how can the company demonstrate that it's a tech-enabled, scalable product which can actually disrupt the market? So that's what one is looking for in today's ecosystem. And traction, it really depends on which stage it is in. In a seed stage, it's a lot more to do with the team, but some traction in terms of, hey, is there some MVP to the product? Or if it's an idea stage, how quickly can it be built? That really depends on how hard it is for somebody else to build it in the same time period. Capital requirement, I just talked about this. Capital requirement in the later stages is a challenge. So knowing that, how do you actually make it very capital efficient to build a sustainable business, which can then attract a lot of capital? What we are seeing is that differentiated businesses which are disrupting the market are continuing to attract capital. There is no dearth of it. There are companies which are continuing to raise 30 million, 50 million, which are differentiated and which are building value for the market or stakeholders. And lastly, very important for limited life funds like ourselves and so many other funds which are in the market, they do look for a finite time period within which they can get an exit. So what we typically suggest to entrepreneurs when we're talking is that while it's kind of a chicken and egg, right? It's more of, we're also saying that you need to build for the long term, but we're also saying we need to get an exit in 5 years. But that's also the harsh reality, where the funds have to keep throwing the returns back to investors so that that money can cycle back, right? And ultimately, who is giving us money is also some entrepreneur like you who's actually made money some time back, right? So unless you give the money back, you don't get that money back here in the system. So you need to keep cycling that money. And that's what is an important factor one needs to look for. And the last part is, this is more with respect to every fund, how can we actually add value because of our experience and expertise? Or if it is just, one other investment where we're just putting money and forgetting it, it doesn't really add to, what we bring to the table as well. So that's something that you should actively ask investors in terms of what's the investor bringing to the table beyond capital. Sorry? High entry exit barrier is for, typically when you are building a product or a service offering, how difficult is it for somebody else to enter the same space, right? So that's the high entry barrier, where it's not easy for somebody else to just replicate what you're building. There is a differentiation in that as well. The exit barrier is more to do with your customer base. What's the stickiness that you're building makes them stick on with you and not just leave you when there is another product coming in, purely because of price arbitrage or any other reasons. Lastly, I would also like to just talk about this, which typically doesn't get covered. What should you look for in investors when you're doing that partnership, right? It's not just about the money. There are, as I said, large pools of capital available. So some of the key things that one should look for is clearly, what's the value that someone is bringing to the table, and is that complementary to what you already have in your team, which can help you scale much faster. And some of those things I'll just not read about, but in terms of some of the key things are, how is the investor helping you in raising your successive rounds of funds, if that is a requirement, which I think in most cases will be. But how is that value coming in? And not just maybe the same investor may put in additional capital, but that's not enough. It's when you have more pools coming in, it's actually just more validation that, hey, the business does have value in the market and market values it. So ultimately there is value accretion that is happening. And lastly, also I would say that the domain understanding is really important, so that you have someone who empathizes with the issues that one faces in building at a very, very early stage. What are the challenges one goes through? And typically we have seen whenever we make an investment, there's a business plan, and guaranteed that in most cases the business plan is not adhered to within 6 months, right? Now at that stage, how do you react to it? Do you kind of look at it and say, hey, it's failed? Or do you look at it and say, why did it not happen? what are the issues, and what are the factors contributing to it, and how do we fix it. So I think that becomes very important in making sure that there is a chance for the business to succeed. Having said that, I'm not saying that you have somebody who's just sitting quietly and saying, do whatever you want, and it's fine. But there has to be some rational way of deciding, is there a challenge in the business? Is there something that the investor can add as value to ensure that issues are fixed in a very early stage? So that said, that's what I would like to just conclude with. I think in summary, there is quite a lot of capital. The trend in the market is that there is pools of capital available in various stages. Definitely in the seed and early stage, there is quite a lot of capital, but people are looking for very, very differentiated businesses. To that extent, it's really, compared to last year, there is lesser number of investments that are happening, and rightly so, because if you compare it to what it was happening in 2014, it's probably in the same levels. And I would not expect it to change too much in the next 1 year or so. It would probably be a similar number that would get invested in. And ultimately, it really depends on how differentiated businesses are getting built over a period of time. Great, happy to answer any questions. Thank you very much, and I can be reached on the email ID that I've put up there, and also reachable on Twitter. Thank you very much for your time.
Hi,
There's
Karthik.
one question there, yes.
My name is Shubho. I'm one of the co-founder of one of the startup, artist startup, Right Cloud Technologies. My question is what are the key points you look at when you evaluate B2C and B2B companies? What are the differentiators you look for to select them?
Sure. It's broadly the same, what I kind of talked about. We look for the team. What's the skill set that the team is bringing in? If it's a B2C, there is not much of a product angle there in the early days at least. What's the understanding of the consumer that the team is bringing in? The team may be just out of college, or the team may have significant experience in actually building products for consumer markets. What is that knowledge on the consumer base that you're targeting, which the team is bringing in, because of which they're able to address the need of the consumer in a quick manner? So that's what we'll look for in the team, apart from some of these points. Whereas in a B2B, it's completely different. You're not really worried about what are the connection one has to get the sales done. Which market is the team targeting? And if it's say if it's a global market, your customer base is really in the US. Do you have someone in your team who has experience of selling products in the US? Becomes very important, which is very different from what one looks for in B2C. And all the rest remain the same. Is it a large market? Whatever market you're targeting, is it a large market, and is it an unmet need? Or is it a market creation process that's happening? Typically, when it's a market creation that's happening and not an existing unmet need being solved, you will see lesser number of investors looking for it. You'll still have 1 or 2 investors who will be actively looking at it, but in general, the market will not look for, VCs in general will not look for market creation kind of products. Simple reason being that that takes a long time. As I said, VCs will look for exits in 5, 6, 7 years, and unless you are kind of a large pool of capital which can sustain that, it's very hard. So you'll have a couple of them who will be very actively looking at such opportunities, but mostly it will be existing market unmet needs. And in terms of traction in a B2C company, one may look at even maybe like 50,000, 100,000 users who are there as good, so there is some validation. Whereas in a B2B kind of product, the numbers will be very different, because it really depends on what kind of market one is looking for. Is it enterprise? Is it SME? So to that extent, that numbers will keep varying, but broad themes will remain the same.
I have one more question. Do you have any numbers on how much investment went into cloud-related products, specifically the startups from India, which may be targeting global markets or probably Asia-specific or EMEA markets in last few years?
Yeah. So I think till around 2014 end, it was very, very small, very few. I think mid 2015 onwards, I don't have the exact number, but we are seeing actually that number going up. A lot of companies which are starting from India, but very quickly, ramping up the sales because of inside sales, and having one person in the team who is probably spending a lot of time in the market where they have customers. So in the last, if I were to just take a gut-based estimate based on what I know, out of that around 800 million which I expect to happen in this year, maybe around 20% would probably go there. But that number was much smaller in 2014, I would guess. But that number is going up now.
Thank you.
Do you have a question?
And that's all, sorry, just to add, that's also a very big differentiating factor today, where investors are looking at cloud-based solutions which have a very unique technology being built as an interesting proposition to look for investments, which was not the case maybe 2-3 years back.
Hi, are there any companies that you met and not invested and later realized that you should have invested? Any interesting takeaways?
There's so many. I think I'll need 1 hour for that only.
So any interesting characteristics that you see that you didn't find it at the time when you met them, but you found them in the next 1 year that they scaled and stuff like that? Any interesting observations?
Yeah, I think broadly, see, our decision making is mostly based on the team and market. So in some cases, we would have probably erred on taking a decision on the team. We would have thought that the team may not have all the skill sets, but we are proven wrong. In some cases, we would have seen that the product does not have a market, but they've actually proven us wrong. And it's actually all these factors why we would have missed an opportunity, but there are quite a few opportunities that we've missed.
Any other questions? Okay, one there.
There's quite a cliche that for a team, when investors look out, they look for a resume consisting of IIM candidate or IIT candidate.
Did I say that?
No, you did not say that, but then it's a common.
I never said that.
Yeah. So I mean, if someone is not IIT, IIM, and they don't have a great thing in their resume about it, then how would you suggest? How do we prove ourselves that, I'm in front of the investors?
I thought I already answered. So I never said that. That's the point. So if you have these parameters, there are enough investors in the market who are open-minded in looking at what is it that the team is bringing to the table, and you just need to probably approach the right investors.
Any other questions? Okay.
I have not studied the Flipkart example very well, how they started off in the beginning. Did they really make a pitch to the investors saying that they are going to become this size of a Flipkart or not? But except for the Flipkart example, I have not seen companies becoming one more Flipkart or even trying to become one more Flipkart. How many such requests do you see, and how do you approach such requests?
So I would disagree with the first part. There are, I think, quite a few companies in India which are, highly successful in their own merits, and there are quite a few successful cases that have been built from India, both for the global market and within India. And there are some of those in our portfolio itself, including Flipkart. But having said that, I think on a daily basis we do keep meeting entrepreneurs where the opportunity is very large, and the company is targeting being $1 billion company in a 5-year time frame, and we keep seeing that very regularly. The key aspect is that demonstrates that there is a very, very optimistic, very strong vision that the entrepreneur is coming up with, which we completely respect. In a very early stage, the key is, does the investor do believe that there is a large market opportunity? Now the number may be 1 billion or 100 million, which is very different, and it doesn't matter in the bigger scheme of things. But do you see that there is a large market and you can actually scale very rapidly given all the parameters are right and some of these parameters are right. That's what we look for. And the number, end of the day, is fungible. One may say that I'll become a billion-dollar business, and I've heard such stories personally. And in some cases, once you aim for $1 billion, you're probably getting to a 50 million, which is also great, right? So no complaints on that. We typically see more than 200, 300 companies every month, and I'm sure quite a few of those are of that nature.
Another question. Okay.
Usually, do you prefer, I'm trying to understand the pattern, how you actually, those things that you mentioned, if I am coming for funding, I can say that I have few of them or I don't have few of them. And obviously, you might be having your own structured way of, verifying or validating that. So do you prefer a company or a startup being part of an incubator already? And then, where do you go for looking? You obviously have to have some places to look for startups where you can trust something, right? You have some incubators you guys look for, and then people already churning into that incubators have some proven stuff there, or where do you look for, and how do you really judge if I say I have some of those few things with me?
Sure. So I think the venture business is very similar to how you may be building an enterprise business, where on one side you're just building the entry into the funnel on various dimensions, right? Even in an enterprise business, you would do that. Even in a B2C, you would do that, but in a different way. But this is more similar to an enterprise business where you have a sales funnel, you're building your funnel with a lot of things coming into the input, and then you're kind of filtering it out so that you can actually get the final convert. So very similarly, our input is mostly personal contacts. All of the team members have been in the market for a long, long time. I've spent all my life in Bangalore, so I do believe that I have a pretty strong network in Bangalore. So like that, we have multiple team members who have very strong networks, because of which people approach us. And I do believe that we have a pretty strong brand, so people approach us as IDG. And the third part is, in conferences like these, we get to meet very interesting people and get to understand what's happening in the market. That's another part of the deal flow. A fourth part of the deal flow is something that we pursue very actively. These are the 4 sectors that we focus on. Within each of these 4 sectors, we keep building thesis, and based on that thesis, we keep looking out for companies pretty actively. So we kind of do a very targeted program, look out for a company in fintech. Within fintech, maybe some sub-segment, and this month it may be different from what we'll see next month. So we kind of keep building thesis in-house and start looking for what kind of companies are there in that space. And that is another source of deal flow. So based on that, you kind of look at all parameters and then evaluate them. And maybe in the first stage, a lot of those get filtered. And then we start looking at the smaller set which is filtered and spend more time on that.
Karthik, if you don't mind, I'd also like to get Sunil's perspective on how he looks at
Please.
investing. Well, we're also privileged to be joined by Sunil Rao, who is recently joined as partner at Lightspeed India Partner Advisors. Sunil, would you like to add anything else?
Thanks. You almost put me on the spot, but it's okay. Just to add a couple of things on what Karthik covered most of the points. I'm not giving very specific answers to all the questions, but I'm just talking about my overview as well as my observation. One thing which is really effective from your standpoint as to if you want to get Karthik's attention, what's the best way? 99% of the time, look at all the investments from his portfolio companies and convince one of the founders to recommend you to send a mail to one of the partners. And that is the most effective way if we take our word from the founding company, because they've already been working with us, right? And they know how we operate. They've already gone through the entire due diligence process, and they have raised X amount of funding. So they have been successful, right? So ask their advice as to how does it really work if you want to convince XYZ person. And if you're able to convince him, and he's convinced, and he does an introduction mail to a partner, that works really well. And we take it very, very seriously. There's a lot of random emails we get on a continuous basis, which most of the time we won't be having any kind of a bandwidth to look into it. Most of the private equity investors, even most of them who have been angel investing for a very long time, they do send us a lot of referrals. We look at very seriously. But the most, if you're looking at the category as to which is the most serious and the most qualified, someone who is existing fundy company and he is able to make a neat introduction about you and able to vote you for that. Second one, coming in terms to talk about a little bit on what we are seeing in the ecosystem and what kind of changes that we are seeing from a maturity standpoint. Unfortunately, even now in this day and age, we are seeing a lot of people just getting hooked on to the original idea and just sticking on to it. So please understand one thing very, very clearly. Irrespective of whether you're a technology guy, non-technical guy, you're a business guy, at the end of the day, you're building a product for a consumer, end customer. It's not your fancy job. It's just not your private passion. It's not like a hobby that you're developing a product. You're developing for end consumers. Please keep that in mind. And I've also seen most of the people saying, hey, you know what, I'll build the product for next 1 year. I'm not even thinking about monetizing. Next 1 year, I'll get 1 million customers. I'm not even thinking about monetizing. Then I'll start monetizing. I'm like, who told you this? Right? Why are you even thinking about this kind of assumption? Let me get 1 million customers. So build a product where you, on day one, are ready to pay around $1,000 for that customer, for that product. If you're not convinced, don't even build your product. You're wasting everyone's time. Right? So that's the 1 or 2 points which I really wanted to highlight. And there's nothing wrong in pivoting, guys. Let me tell you, it might sound really fancy, but if you're able to listen to your customers and pivot it immediately, take it like a continuous iteration. How many of you even know that Snapdeal iterated 8 times before coming out with this kind of a model, right? And they're reasonably successful, right? There's nothing wrong. Most of the companies do pivot, and it's healthy. If you're not pivoted at all, and if you're still sticking on to the original idea, there's something wrong with you. Or you feel the customers don't know. Or if the customers are giving feedback, please incorporate that and do something which is realistic. Okay, thank you guys.
Thank you so much, Sunil.